Welcome to Making the Deal Frameworks for Transactions, the podcast focus on lower middle market transactions and how to bring them to a close. I'm Joe Allen.
I'm Shawn Mercino, and before we get into our guests, just want to recap our last podcast. We had David Hamilton from Kickpoint Ventures, and he was chatting with us about the journey before a sale. So a lot of our podcasts focus on the mechanics of a sale and kind of the parts of that, but that was a good conversation kind of talking about the journey before you get to that point. So check that out on YouTube, on LinkedIn, on all of the other platforms, Apple, Spotify. Like, subscribe, comment, engage. Let us know if there was anything in that podcast that was interesting. So we appreciate your support on the podcast. So moving forward, today we have Kevin McCaron with us. He's going to chat with us about insurance, its role in transactions, and kind of the market overall, maybe some updates and some key things happening. We're going to talk about the application process all the way to a bank closing and what a bank needs. So there's a lot of different components that a bank would need to get a deal done for funding, and not just a bank. It could be any kind of financing. It needs to have this kind of insurance as part of it. So that is on a purchase, maybe a property, maybe a business acquisition. So that leads us to the M&A conversation, which we'll dive into as well.
Yeah, and look, we're very lucky to have Kevin on the podcast today. We're excited to have you give everybody all the knowledge that we completely lack. Kevin is a very close friend of both Shawn and I. His experience in the insurance industry is pretty much unmatched, and he's going to give us knowledge on a little bit of everything that goes into the transaction. So, Kevin, welcome to the podcast. Please do a brief introduction and give everybody a little bit of idea who we got on the other side of the table here.
Sure thing. A very nice intro, Joe. Yeah, we've known each other for a little while now, and I do consider you guys my friends, so we're friends.
Thank God.
I don't think that'll change even after this. So yeah, I've been in the commercial insurance industry for roughly 26 years. I'm currently with Gallagher Insurance Services. I had former stops at both Marsh and Willis Towers Watson. I've been involved with the M&A sector of the commercial insurance world for probably about the past 15 years or so. But I've delved into a lot of other different things throughout my career. I've worked with Fortune 500 companies, global companies, middle market companies, small business companies. I've done all kinds of insurance products, ranging from almost every single one of them out there. Also done a lot of captive structures, single parent captives, group captive structures. So when you've been around as long as I have, you aggregate a lot of wisdom, you have a lot of experiences. So hopefully that comes across today as we talk.
We have no doubt.
Absolutely. No, it's a beneficial conversation for us, but we know for a lot of the listeners too, because the insurance world might not be as clear for a lot of us out there as it is for you, having worked in it for a while. So,
valid point.
We appreciate you being on with us. I guess let's jump in and start on the open. We mentioned a little bit about banking and its need, a financer's need for clean situations. And that might be on environmental, that might be on P&C, that might be general liability. Can you maybe walk us through the different types of insurances that you see needed when it comes to bank financing?
Yeah, typically when we're looking at transactions between a buyer and seller, the companies, on both sides of the table, I mean, they should be familiar with the property and casualty insurance that they need. So you've got your primary casualty, which is your auto coverage, your workers' comp coverage, your general liability, which is premises liability and also products liability, ongoing operations and existing and completed operations. And then you have, property insurance. You have insurance for excess liability up to a certain amount of limits above that. And those would be considered your main coverages. But then there's all kind of specialty coverages that come around it, like pollution, like directors and officers liability insurance, employment practices liability insurance, crime insurance, cyber insurance. Yep. We can go on and on about these other specialty insurances. But that's kind of what I specialize in. Normally when we get involved in employee benefits, I usually, have a colleague with me that's more of a specialist in that. I know enough to be dangerous, to be honest with you. But we delve into some other stuff too, some private client stuff like, key person life insurance policies and things of that nature as well.
Yeah, which those policies can be super useful. Like the life insurance policies, specifically on the lower end of the market, like you can use those extensively in SBA transactions.
Yeah, absolutely.
Those life policies can be used to stopgap the
Yeah.
the collateral shortfall, that kind of stuff. So those things can be very useful for transactions from our standpoint as well.
Imperative for sure. I mean, in the lower middle market space, specifically the SBA, life insurance policies, if there's a sole owner and there's a collateral shortfall, we need a key man life insurance. So it's very instrumental, that particular type of insurance in the lower middle market space.
Yeah, absolutely. Okay, let's talk about an insurance that I have seen used extensively by asset-based lenders historically. I will see bank lenders use them as well, but trade credit insurance policies. There's obviously it's a product that's been around for a long time, and I think it goes in waves and how much it's usually used depending on what's going on. Right now, I think we're in the high point of one of those waves where people are using it pretty extensively because for either non-payment issues or whatever it may be. But why don't you walk us through like what a trade credit policy is?
Yeah, so essentially what that boils down to me, I call it accounts receivable insurance, right? And normally you see a lot of retailers that work with, wholesalers and distributors and manufacturers of products that are supplying stuff to them. Those manufacturers, those distributors, wholesalers, they'll sometimes go out and buy the trade credit because, the retailers, have to pay them, for the goods that they're supplying. And so a lot of retailers will have to take it out either for them or they'll take it out and on behalf of the retailer. And normally when you see it used a lot is when you're in a recession. When you're in an economy that's not so well or that's hurting or is trending downwards, you'll start to see the product used a lot more. When the economy's humming and everyone's paying their bills on time, you don't see it as much. But it's a very good insurance to have, especially when it comes to bank financing.
Sure.
A lot of times companies, if they're, looking to extend their credit or their payment terms on their loans, if they have trade credit in place, they're looked upon more favorable by the banks, right,
Sure.
Shawn? I mean,
Absolutely.
It probably looks a lot better if they have trade credit. It's less of a risk for you guys with respect to your loans and your payment terms.
Sure.
Yep.
So it's used for a variety of reasons.
Yeah. I also see it for international receivables. It's a way that lenders can get comfortable with because look, every country has different laws about collateral and all that kind of stuff. So oftentimes those policies are very valuable when you're trying to do cross-border finance type projects.
Yep, that's a very good point.
I guess the thought that through this conversation came up, do you see both sides sometimes bearing the cost of that? Or is it situation dependent where if maybe the buyer's encouraging the seller to have it or vice versa, the seller's saying, I think I can get a higher price? Is it who usually bears the cost of trade credit insurance from your perspective?
Usually it's whoever is waiting for money to be paid to them,
Sure.
right?
Yeah.
It's whoever has that account receivable, right? I mean, whoever has extended themselves out there on credit and, their customers or their trading partners, they owe money. I mean, it's truly just account receivable insurance.
Yep.
And that's usually who pays for it.
Okay.
Unfortunately, but it makes sense, right?
Yeah.
It's a risk to them.
Yeah.
And it's an advantage to them too, like you said, when it comes to banking terms.
Yep.
It looks it's more favorable. They get better banking terms, better payment terms from the banks, and they get more credit as well from the banks.
It could be used as a growth tool for sure.
No doubt, and that's where we've seen a lot of our clients use it.
Okay.
Yeah, and look, we're working with a company right now. It's actually on a sale, but they had to redo their financing last year. And they were coming off kind of a down period where they had a big receivable write-off. And the lender asked them to go out and get a credit insurance policy, trade credit. And they got it, but now they have to renew it this year. And there's a very surprising name on there that you would say, I can't believe that their receivables are not.
Right.
Yeah, you'd be surprised.
Yeah, so it's very interesting when you see like who gets excluded from those policies because they're not taking care of their customers.
Yeah, I think what happens is, especially with retailers, there's retailers out there like you wouldn't believe that they weren't paying their bills, and they aren't, and they get a reputation, right? And in the trade credit insurance arena, there's only so many carriers that underwrite it. It's a handful.
Sure.
Yep.
And they know who all the the
non-payers
are.
are.
Yeah, they know. So when they see, when they're underwriting a company that is supplying goods and products to that retailer, they might say we're going to exclude that one company.
Yeah.
They might provide it for everyone else on the policy, but they may have an exclusion. specific just to that company.
Interesting.
Which then might cause the lender to say, look, we're not going to go full advance on that specific customer, right? Like it might be a lower
Discounted,
advance,
right.
especially if it's a really prominent part of the AR borrowing base. Like that can be a really huge issue. So, it can limit availability, but it also is a huge enhancement sometimes in terms of getting a deal done.
Yep. Then there's been situations where I've had retailers before that have told me that, well, we'll get the policy and we don't care if that one retailer or two retailers are excluded because we do so much business with them because they carry such weight in the marketplace. They want to do business with them that badly that they look past that risk.
Yeah.
Right.
That makes sense.
Yeah.
Interesting.
So,
Well, let's pivot to the dreaded phase 1, phase 2, environmental liability. And, we all have encountered it in some format in our business lines, but can you maybe walk me through a situation or what somebody who's looking to get insurance for is solving for? So, dirty properties, either vacant or manufacturing facilities, maybe known or unknown, right? Correct. I mean, maybe walk us through some of what that looks like and the options out there.
Yeah, I guess I would start out by saying, let me just give some historical perspective first. So I think it was 1980, CERCLA came out, the Superfund facility. That was passed as a law. Then RCRA, I think, was 1975. And then basically what happened was your normal general liability policies, by 1985, they completely excluded pollution legal liability. Okay. There was no coverage for it. Cool. So they caught on to it. It was getting just really expensive, and they were getting a lot of claims, so they just completely excluded it. So now if you have that exposure, you have to go out and buy your own pollution legal liability policy, right? And there's on-site and off-site. So on-site is typically it's fixed on your sites. It's for known and unknown conditions typically. And then also off-site, you're responsible. If you're generating any type of waste, right? You're manufacturing chemicals, you're handling chemicals, you have storage tanks on your property. It's your responsibility. And you are responsible from cradle to grave. In other words, it's not just for on-site. It's like as soon as you take it anywhere, even when it's in transportation, in transit, to wherever it's going to be disposed, you got to make sure it's covered all the way through that whole process, all the way to the disposal site. And when you dump it and dispose of it, there's a possibility if something happens and there's leakage there, everyone who dumped there is eventually going to get named in a lawsuit. And the government's going to get involved and it can get real nasty. You just got to make sure you have coverage all the way through it if you're dealing with any type of waste on your property.
Interesting. Do you see that as a blind spot often for people, the off-site? Because that is a concept that's new to me.
Yeah, it's been around for a while, but when you tell people that they're responsible for it, they're kind of like, we are?
Right. I would imagine.
I did what I was supposed to do, right?
Yeah, they're like, I took care of it. I got rid of it, and I contracted with another company to dispose of it.
Yep.
Sure.
It's like, even though you had third party literally come on your site, take all your waste away, and take it somewhere, you better make sure where are they taking it, where are they disposing of it, how is it being treated at the disposal site. I mean,
interesting.
Make sure it's a legitimate disposal site.
Sure.
You don't want to just give it to the transportation company. You don't know where they're going with it. There's a concept out there that's known as midnight dumping. Who knows? They might be going to a vacant land and just dumping it at midnight.
Right.
I mean, we've seen those type of things. It's crazy what people. I think they're a lot better now today, but in the past, like 20, 30 years ago, I mean, people would dump stuff wherever.
When there wasn't the all-seeing eye looking at you at all times, Sauron over in the corner.
Exactly. So we see that with the phase 1, phase 2 studies. That has a lot to do with it. It'll tell underwriters exactly what's going on with the property, and then they'll rate it based on typically, how are they using the pollution at the site? What type of pollution is it? Is it chemicals? Is it a byproduct of the products you're making?
Yep.
Where are you storing it? How are you storing it? They'll look at the number of sites. They'll look at how large those sites are with that type of waste on it or pollution on it. Mm-hmm. And then they'll look at what's your risk management program that you have in place. That's a big deal. Like if you're really serious that you have a risk management program around exactly how you're taking care of that waste and pollution on your site,
Yeah.
right? And everyone's following through with the protocols.
Right.
You're storing it properly. You're having it taken away properly. You're going to a legitimate disposal site.
Yep.
So they'll look at the risk management as
A lot
well.
of paperwork involved with
Right.
that, making
Correct.
sure it's all being kept and good files, all
Yeah,
that kind of stuff.
yeah, for sure. And then
Yeah.
underwriters will like to see that because they know that you're addressing that risk with as much safety as possible
Yeah.
surrounding it. And then the last thing they'll look at historical claims. Have there been claims
Okay.
for pollution on that site before?
Yeah.
So these are all the things that you have to think about. And I would also say that, there's probably about 9, 10, 11 carriers that underwrite this type of policy. And I would say almost all of them have a different form. Some of them have like 3 or 4 or 5 of their own forms. So they're kind of customizable in a way. There's not just one standard form like there is for like your primary casualty and your property policies. So I would say, work with your lawyers, work with your insurance broker, and make sure that the terms and conditions in those policies are definitely meeting, your type of operations and the risks that are involved with the waste and chemicals that are on your property.
Yeah, and look, these policies for any kind of transaction, whether it's a loan or whether you're selling a company, can be a huge asset because there's neither of the bank lender or your lender period, nor the buyer is going to take any risk on this stuff. I mean, banks
Correct.
are very strict.
Right.
Yes.
Like they're going to start with especially let's say you're in a manufacturing company and you've got some oils or something, like you're cutting metals or something like that. There's a lot of lubricants, there's a lot of oils, there's a lot of potential waste there, or you just got a lot of metal on the ground because shavings and
Yes.
you're spinning, all that kind of stuff. Like that can be a real issue. So we see at least a phase 1. I mean, obviously everybody'd like to get away with just a baseline if you could, but phase 1s are very common, and if they find something, you might have to go to phase 2 and core samples, and it's a very expensive process, and you get through that, it might tell you that there's some remediation needed. You've got to do all that up front,
Right.
even before you get the policy,
do.
right?
Yeah,
So
you really do.
like the policy's not going to come into effect and just say, okay, we'll take
Cover
all
that,
your
right.
risk here.
Right.
Yeah.
But the policy is to protect from, let's say you do have to do some remediation, which can be very
Yeah.
expensive. It's going to cover anything that maybe was not found during that process, right?
Yeah, it'll cover things that are unknown,
Yep.
but also there are policies out there that will give you coverage for pre-existing conditions. So, but it depends on the nature and degree of what those conditions are
Sure.
on the property, right? And that's what a phase 1 and phase 2 tells you.
Yep.
Right? When you get really in depth in a phase 2, it's like, well, okay, we know there's contamination. How bad is it?
Yeah.
Right? And then that kind of assesses it for you. You
Yeah.
analyze it. You quantify like how bad it is. And, carriers are out there that will give you coverage under their policies for pre-existing conditions.
Interesting.
Now, if it's really bad,
Sure.
you're probably not going to get
You're
that
toast.
coverage.
Right.
Yeah.
Yeah.
You're in
Look,
trouble.
anytime, so something you mentioned earlier, anytime I hear like there's a tank, an underground tank,
Yeah.
I know we're toast.
Yeah.
Like there is no such thing as getting around that. Like it's just the nature of them. Like they get beat up when they're installed. They get over time. They've been down there a long time. Like there's a lot of humidity under the ground, all that kind of stuff. Like anytime I hear that as part of a transaction, I'm like, oh, we just added 45 to 90 days to our
Right.
transaction.
Sure.
Yeah.
It's just a reality.
It is a reality. And those underground and above ground storage tanks, I mean, it's pretty much mandatory coverage
Yeah.
that you have it. And those are separate policies. So those aren't part
Oh,
of the
interesting.
pollution legal liability policy. They're literally called storage tank policies. And they're separate and independent from a typical pollution legal liability policy.
Wow.
So,
Yeah, look, I've seen the leaking tanks underground that caused my client to have to do a bunch of remediation before we could close on a transaction. Look,
it can kill a deal.
Right.
oh, absolutely.
Elongate
Because
at
nobody-
minimum.
Yeah.
It could elongate at minimum, kill it
Yeah.
at worst.
Yeah,
Or lose
nobody's going to
financing.
take. I mean, that's a massive amount of liability for
Sure.
somebody to take on, especially if that real estate is the collateral for your bank
Yeah.
lender. Like,
Yeah.
what are you going to do if it's now
Right.
like?
It needs to be in compliance. And to your point, I think each bank is different too on how they view it and their willingness to work with the existing work that's being done. And part of that's their experience, but appetite's similar to a carrier insuring it. the appetites from banks on what they're going to allow are different too.
Yep, totally makes sense.
But so I know, like 21, when a lot of these policies were going crazy, you guys did a great event. You headed up an event specifically that was covering like some of the RWI and
Yes.
which we'll get into here shortly, but also the environmental stuff. And
Yep.
you guys spent a lot of time talking specifically about PFAS, which for everybody who doesn't know is known as the forever chemical. It's all the stuff that's in your water that gives you cancer and all that
Yeah, it's on your pizza
fantastic
boxes.
stuff that we want,
know.
right?
Right.
Yeah,
It's on your
exactly.
magazine covers. Well, no one has magazines anymore.
But so like, what's going on with? What are you seeing in policies? Those types of policies, like, is that covered? Is it excluded? Is it somewhere in between?
Well, if you would have asked me that question a few years ago, everyone, would have said it's excluded.
Yeah.
No one wanted to touch PFAS.
Mhm.
I mean, it was the hot thing in the pollution space. Everyone's like, if it's got anything that has to do with PFAS, we're not insuring it.
Yep.
But we've got a team of environmental experts at Gallagher, and I've been talking to them actually over the last few weeks, sort of preparing for the show, and they said, look, people out there will say that it's uninsurable. They have gotten a few deals done recently where they had a few carriers that provided coverage through their policy for PFAS.
Interesting.
So they said it's not entirely impossible. And they said that there's remote chances right now where carriers are starting to build it back in to their policies and not specifically excluding it. So so who knows where that's going to go? But
Yeah.
For the last I don't know 5-6 years, it's been a naughty word, and
Yeah, right.
it's typically excluded in pollution policies.
I mean, probably because they just don't know what the
Yeah.
overall exposure is going
Right.
to be somewhere down the line.
They need a
Like
runway.
somebody
They need a runway
with
to be
a
able to-
lawsuit
yeah.
or something like that could make that whole industry totally unfavorable.
Right.
Yeah, for sure.
And then, what cost-wise for it? So what's driving the cost? And then specifically when it comes to like PFAS, like if there's something like that, is that going to spike the cost? Like, are there certain things that will spike your
I'm
costs as
sure.
opposed to others?
Yeah, I would say, if you're getting some sort of coverage for PFAS, that's going to drive up the premium no matter what. The rate's going to go up. It's definitely a riskier, toxic element you're dealing with. Other things, pre-existing conditions, right? Talked about that earlier. If you want pre-existing conditions, it's probably going to impact price somewhat. But it goes back to what we were saying a little bit about that cost. It's number of sites, how many, not just number of sites, but the size of those sites is what I'm trying to say. Loss experience, historical
Sure.
claims, right?
Going to drive up the price, I would
Yep.
imagine.
They'll review and assess the phase 1, phase 2s. They'll assess the quantity of the contaminants, the historical contaminants. They'll look at also, like I said, the risk management programs to see how they're treating it. What are they doing? How are they disposing of their chemical waste or, whatever toxic waste it is on their properties.
And then are there any industries where you just know that you can't get something? Like I was dealing with a plating facility in the Midwest, and obviously plating is, I don't care if you're doing everything right, plating can be very difficult from an environmental standpoint. Is there anything where you're just like, look, if this kind of industry, I'm strictly not going to be able to get a policy for that?
I wouldn't say necessarily.
As long as you're willing to pay, kind of thing.
Yeah, I mean, every industry is different. It just depends on the type of chemicals and pollutants you're dealing with, on your sites and what you're doing with it. I mean, we even provide contractors pollution liability policies for contractors that deal in waste.
Okay.
For example, I had a client that, their specialty was they were a contractor that would take all the de-icing contaminants from Detroit Metro Airport.
Yeah.
Right? And they would treat it. They would put it in a pool and they would take it and they'd suck it all up in their vacuums and their trucks. And they'd send it back to their treatment facility and treat the waste back at their treatment facilities.
Yeah,
Interesting.
right.
Yeah. So, I wouldn't say per se there's any out there that I can think of that, markets wouldn't touch. It just depends on how they're handling that waste, right? And, there might be certain sites where, it's so bad, it's so ugly that they just don't want to deal with it. Sometimes they're known as brownfields, you know? And there's hundreds of thousands of brownfield sites out there. It's crazy.
And that's where you've got a contaminated site, right?
Correct. Yes, it's a contaminated site, and you may have a municipality that wants to get use out of that land.
Right.
They want to get tax revenue off that land. They want someone to come in and develop it. And some brownfields are better than others.
Right.
Let's put it that way. I mean, there's one here locally that I don't think will ever be developed. They've tried for years.
Right.
You know, it's a place that had major waste on it years ago here in Detroit area,
Yep.
and they can't even get a developer to do it because no one will even insure it.
And typically in those situations, so because you bring this situation up, it's basically just like, hey, we're putting a giant slab of cement down on top of this, right? Because that's all you can do. You can't have people touching the ground and like regardless of the remediation and everything.
Yeah, I mean, yeah, that's probably a good point. Yeah, I mean, you're just.
It's for the development of a big building or something that's going to go there, where you're going to have parking lots surrounding it, that kind of thing. It's typically not going to be like we're going to return this back to. And look, I know there's tax incentives and all kinds of stuff that cities put together for people to try and incentivize them to. You know, there's brownfield tax credits specifically to try and do that kind of stuff.
But your realistic options are limited for what you can develop it into.
True.
Yeah, so I think if you got a lot of cement slab, you can
Probably
do something
that.
there.
And you don't have a lot of foot traffic, and it's not like people going in and out of the property like it's a huge condo complex or apartment complex. You know, housing, stuff like that. Maybe if it's more like industrial.
Yeah.
Right, and there's a lot of cement everywhere.
Right.
So I would take that. That would be like the properties that, like one of the big autos shuts down one of their hundreds of thousands of square feet, and you're, what do you do with that?
Yep. Right. Because it's happened around here before.
Yeah, right. Once or twice, right?
Right.
I'm sure it had nothing to do with the site that you were previously talking about.
Yeah. It's a defunct company now, though. It's no longer around.
Okay.
Yeah, we'll talk after.
Yeah, there we go. Got to know the insights.
Right.
Yes.
Okay, let's pivot now to specifically M&A policy that we deal with quite a bit. And it's become very common in terms of helping bridge the gap in a transaction between the buyer and the seller. And that's what's called an RWI policy, or reps and warranties insurance.
Correct.
So I'll set this up for everybody so they understand it from a active transaction. We've got a buyer on one side who wants the seller to be responsible for everything. We've got the seller on the other side who wants to walk away from the deal free and clear, right? Which I think everybody seller wants to do, right?
With their money and no clawbacks.
Exactly.
Right.
Exactly. Hey, that's what I would want.
Yeah.
I don't blame them.
Yeah.
Reps and warranty insurance is a way, and hey, if you haven't, go back and listen to the episode with Justin Hanna, because we talked about the reps and warranty parts of every purchase agreement, which are extensive and a major part of the negotiations of a purchase agreement. But reps and warranty insurance is something to kind of guide through that, where you can bridge that gap by providing a policy to people covering maybe an error or an omission. So, and you correct me if I'm wrong, but can you
unintentional?
Yeah, right. Of course. Yeah. Oh, yes. Never purposeful. Fraud still is counted under that. That is not covered under that RWI policy. So can you run us through like RWIs and kind of how they apply to a transactions, what they cover, what all that kind of stuff?
Sure. So reps and warranties insurance has been around for a long time. I can kind of speak to its history because I've been around a long time. But they weren't that prevalent like 10 to 12 years ago. Mm-hmm. And then all of a sudden, the private equity, space got so active, and there's, it's a pretty saturated market, along with, a lot of the corporate strategic buyers. In around 2015 or so, they started to realize that this is a pretty effective tool for both the buyers and the sellers.
Yep.
And then all of a sudden, companies just that were buying other companies, they really started to delve into it, and it became more and more ubiquitous over the years. From 2018 to today, it's used on probably more than half the transactions that are out there now.
Mm-hmm.
Where in the past maybe it was like 10 to 15%. And then in 2021, it was at its height when deal activity was just at an all-time high. 2020 was good as well. And then it really dramatically dropped off in 2022.
Mm-hmm.
And then the second half of last year, with deal flow starting to, increase, now all of a sudden we're seeing the increase of RWI policies again. The main ones are reps and warranties. There's two more that are really common out there called tax insurance, and also contingent liability, also known as litigation buyout insurance.
Mm-hmm.
It's very helpful. I mean, it's got benefits to both the buyer and the seller. I'd say a majority of policies now more on the buy side as opposed to the sell side. In fact, on the buy side, you can actually get some fraud coverage on it. As long as you didn't uncover any fraud or knew of any fraud during your due diligence with all your advisors leading up to the close date of the transaction, which is kind of crazy. But yeah, there is an element of that. So this last 2 years with not a lot of deal flow, not a lot of or not as many policies as there were 3 years ago, rates really plummeted. You had a lot of carriers in the space fighting for business.
Yep.
And it's kind of interesting because in 2021, rates got so high because towards the second half of 2021, a lot of the carriers weren't staffed appropriately. So we had a human capital issue, and a lot of them had already met their quota for the year. And so they were literally walking away from deals or just charging crazy rates, double what they used to be. I'd say during normal times, rates typically were around 3% to 3.75%. And then towards the end of 2021, I mean, they were getting crazy up to 5 to 6% for primary limits, which was kind of crazy.
Wow.
And then they were excluding certain stuff. It was very hard to get a healthcare deal done. No one wanted to touch the healthcare space.
Mm-hmm.
So that gives you a little bit of history of it, but it's a great tool.
Yeah.
It really is. I mean, I'm surprised, more and more companies don't use it. I mean, I think it should be part of almost every deal.
I agree with you. I think it just provides I think it helps with the negotiations in terms of like what needs to be covered and what doesn't. I think it's very helpful. But there's also can you talk a little bit like the deal size limitations? Because historically, like for smaller transactions, you really couldn't get policies.
True.
It appears that stuff is opening up, but why don't you talk a little bit about like where you've historically seen it and then where you're seeing it now, because it does seem to be that there's a little more space down in the lower end of the market.
I would say during historical norms, like pre-2020, you would see reps and warranties policies that would come down on deals that had an enterprise value of like $25 million. Okay. And then, with deal flow really, decreasing over the last few years, they started lowering that all the way down to like 10 million. And then I saw some deals that were down around 6 to 8 million enterprise value. Because a lot of these carriers, they're like, we need business. We got to write business.
Sure.
And we bumped up our staffs accordingly. And so, they were willing to go, that low on deals, and they were writing policies for 3 million and up. You rarely see a policy under a 3 million limit, It used to be 10 million, then they dropped down to 5 million, and now you're seeing stuff down to 3 million.
Yeah.
And the rule of thumb is usually you will buy a limit that's 10% of the enterprise value.
Mm-hmm.
Okay. The lower the enterprise value, it might be 10 to 15%. And then the higher the enterprise value, if you get up to 500 million or more, you might see 7 to 8% is the limit that they'll choose of the enterprise value or 500 million. So that's the rule of thumb, and then rates typically right now are anywhere from like 2.25% to 2.75%.
Mm-hmm.
Not the 5 and 6 of late 21.
Yeah. Big difference. I mean, that was the lowest I had ever seen the rates in the space, but that's essentially changing now. You're already starting to see an uptick because deal flow is increasing just in this first 2 months of the year.
Yeah.
And so, I'm advising all my M&A attorney buddies and my private equity buddies and corporate buyers that are clients of mine that, guys, rates are great right now, but they're going to start rising, and they'll probably get back to their historical norms of 3 to 3.75%.
Yeah.
And then you got to also tack on an underwriting fee, and typically the underwriting fees range anywhere from $25,000 to $50,000, depending on the carrier you choose. I would say really though the range is really $30,000 to $40,000.
Okay.
Yeah.
Is normally what I see. And that's once you pick a carrier and they go through the process, that's non-refundable. So if you don't get the deal done,
Sure.
unfortunately, you're stuck with that fee.
Yep.
Because they go through their diligence, right? Once all the due diligence streams are finished, financial, legal, tax, insurance,
Yep.
they go through a rigorous underwriting process where they will sit down with all the advisors that put those reports together, right, for the buyer, and they'll conduct like a 3-hour underwriting call. And so they do a lot of diligence before they actually finalize their proposal,
Yeah.
for the policy at closing. And, once they go through that process, the deal all of a sudden blows up at the last minute, they're still entitled to their underwriting fee
Sure.
because they put in so much work and
Absolutely.
effort.
Look,
Right.
they basically need access to the data room. Like
Yeah,
they are
yeah, they-
looking
Right.
at
And they do.
everything that
Yep.
you're talking about. Like they are reviewing the purchase agreement to see what's covered and what's not. They're looking at
They scrub it all.
yeah, absolutely. So, and then when the policy comes out, now both the buyer and seller have to take a look at that and review that policy, right? And see what's covered, what's not. And that may affect negotiations about, what are we going to agree to versus give a little leeway on.
Yeah. I think once you pick a carrier, you get the quote, you have the proposal. You want to then look at the terms and conditions and making sure that they're commensurate with the purchase agreement that's in place and the reps and warranties that are in the purchase agreement. You want to see if there's any particular exclusions, right, that are there as well. And both sides kind of look at it, right? So that's they try and tailor that policy as the best they can to the exact purchase agreement that's
Right.
being closed on.
Yeah.
So that negotiation goes on for maybe another 3 to 4 business days leading up to the closing. It's almost like the last thing that's done before they actually finalize the policy and close the deal.
Yeah.
And then I would say timeline wise, I always tell everyone, as soon as you start your diligence streams and they're getting close to being finished, that's when you really want to tee up the reps and warranties process. Thankfully, it only takes usually 1 to 2 weeks to get it done. And that process usually is, there's an initial submission where, the broker will ask for copy of the draft purchase agreement. They'll want to see financials of the seller. They'll want to see a write-up on the operations that are being bought, the seller's operations. And then what they'll do is they'll take that out to 20 to 25 markets in the space. And a lot of, those that want to bid on it, they'll come back. And, you'll have what we call non-binding indications from all these markets. Then the broker goes back and sits down with the deal team. And it's usually most, like I said, are buy side, so I'm using the buyer in this example, but sometimes it could be the seller as well. And then they'll take a look at, what their rates are and what their premiums are and what their underwriting fees are. And there's other things to factor into it. Some are more amenable to, customizing their policies a little more for, the buyer and the seller. And some might be better at paying claims than others. And we know
Interesting.
which ones like to pay claims and which ones are difficult.
Yep.
Sure.
And you got to contemplate that too. And just to touch on claims, I mean, it's, to date, I think I just read recently that I think of all the policies that have been issued out there, about 20% of them get claim notices. And of those 20%, only 20% of those actually pay out claims.
Interesting.
What you'll find, though, is a lot of them end up in the deductible, in the retention. So
Okay.
in a normal retention, going back to historic norms, maybe pre-2020, the retention / deductible was usually 1% of the enterprise value of the deal. So, if it was a $100 million deal, it was $1 million.
Yep.
And usually when that, and depending on what's negotiated, normally the buyer and seller would they would share that deductible if a claim was made before it would actually get to the insurance. But now deductible and retentions are coming all the way down to probably 0.5% on middle market deals, but the smaller deals that are ranging from 6, 7, 8 million enterprise value, they're coming down to 0.1%.
Oof.
So even the smaller deals are going down to that, to either 1 0.1% of 1% to 0.25%.
Well, the M&A
Interesting.
markets have been quiet, right?
Yeah.
Like they got to try and make it happen
Drum up
somehow.
activity.
And,
Yeah.
And correct me if I'm wrong, but my understanding is the reason that it's so difficult to do it on the smaller end is because basically they have to start syndicating those deals. You won't find somebody who's like one company who's going to carry that policy. So they're finding a bunch of smaller players that are getting together and syndicating it, which
Yep.
now is like a lot more work because you're bringing more people to the table to
True.
fund those small, or not fund them, to
underwrite
provide.
them.
Yeah, exactly.
Yeah. That's true as well. You know, I mean, the thing you'll see there though is like, you know, they run into minimum premiums. I mean, you know, I can say that the lowest deal I've seen is 50,000 on a deal, but you know, I've talked to you, Joe. We've talked about some other products that are out there, and I think I've seen, or you've told me, I should say, or it's even lower than that, right? The actual premium?
Not below 50. So,
No, you
so
haven't seen below 50?
A deal we're doing right now with the underwriting fee, I think is coming in at about 90,000.
Okay. So that's
And I
around
think
50,
then
but-
the underwriting fee is either 25 or 30 of that. So it just a little bit above it, but
Yeah.
not much.
Okay, so you haven't seen
Yeah.
one. I have not seen one under 50 yet. You know, and
There was somebody who told me there was a product out there that I think had like a $10,000 underwriting fee, but I haven't utilized that product, and nor have I come across it. So
yeah, it's that's not a bad deal if it's only 10,000.
yeah,
So haven't come across that one, but you know, I can tell you during historic norms, the minimum premium usually was around 150,000.
yeah,
You know, and then it kind of dipped to 100,000, and now you're seeing stuff all the way down to 50,000.
yeah.
But you know that might change here in the next year, right?
Sure,
I
the
keep
market
telling
could-
everyone,
right.
You know, the market's very favorable to buyers and sellers right now in putting deals together, especially on the smaller deals.
Mm-hmm.
And you know, that might change. You know, there's a fluctuation with reps and warranties, depending on really it's deal flow.
Sure.
You know,
Yeah.
how many deals are being done and how many are utilizing reps and warranties insurance,
Yeah.
right?
Yeah.
interesting on the claims.
And it's been, you know, we talk about it a lot. It's been a quiet couple of years. And
Right.
It's affected the banking industry. It's affected the M&A industry. It's affected everything.
Yeah.
So, yeah, I'm not surprised to hear how much those rates are dropping. And basically everybody's chasing a good deal, right?
They are. You know, and one thing to pivot from there is I could really touch upon too, just kind of the benefits,
Yeah.
right?
Yeah,
For the,
please,
to
yeah.
the seller and to the buyer. You know, probably the two main benefits for the seller are, one, the seller gets to pretty much walk away, right?
Yep.
You know, they don't have to escrow any of the sales proceeds, or at least have some of it held back, which is terrific for them. You know, they get to walk
Right.
away and don't have to worry about, you know, the buyer coming back and suing them later on
Yeah.
for, you know, something, you know, that
Or nickel and diming them for
Right.
that money. Like that can be a whole thing.
Yeah, correct. And you know, really just facilitates the deal for them, right? It gets the deal done because a lot of times you get into a stalemate, and literally for the sellers, sometimes, like right now in this environment, you can get like no seller indemnity reps and warranties policies. So literally, the seller can say to the buyer, "We're not indemnifying you for anything." So it really works out in their favor because there's still policies out there that will still cover that without them providing no seller indemnity,
Interesting.
Yeah.
which is really amazing.
I mean, that peace of mind. Like to walk away and literally walk away and be like,
Right.
Yeah. It really is something. And then on the buyer side, there's a lot of advantages, right? For them, you know, there's counterparty risk, right, with the seller. It's like if something goes wrong, and you know certain things you know weren't represented correctly, and they breach them, you know, are they going to be able to go back after the seller? Has the seller already spent all their money? Have they done
Sure.
something with it?
yeah,
Because you never know what they're going to do with their
Right.
money. This allows them to know that they have a better risk with an insurance carrier that's typically solvent, has money, you know, and they can make a claim against that policy, and they know it can be paid
Yep.
if it's valid.
Right.
Right. So that helps them in that regard. It helps them in the bidding process. Like if they're in an auction process, it enhances their bids against their competitors.
Mm-hmm.
Right. So that's another thing that's really good about it. Another reason why buyers like it, trying to think what the other thing was here. There was one on my mind, and I just spaced on it. But I'll come back to that. But, but there is a lot of benefits, for the buyer as well. So, at the end of the day, it facilitates the deals.
Yep.
It overcomes any stalemates. It makes negotiations easier. I think that's what I was trying to say. Is that, they don't have to worry about pushing the seller to represent and warrant everything.
Right.
Right? If they know there's a policy in place and a few things, drop through that just aren't caught, they know they have a policy that they can still rely on as well. So that was the other benefit that I was
And good
of
attorneys should be protecting their clients
Right.
from these kind of things and not letting them to sign on to everything, right? So that's, to your point, that's where it can really be an enhancement for the buyer.
Yep. Oh, I just remembered the one other thing. So generally in a purchase agreement, you have general reps and fundamental reps. And those may only be good for 12 to 18 months.
Yep.
And when you buy a reps and warranties policy, it extends those time periods. They go from 3 years to 6 years. So it elongates the survival period of the actual reps and warranties that are in the purchase agreement, which is beneficial to the buyer as well. So.
Yeah, I'm glad you brought up the fundamental reps. I actually...
Yeah, sorry, I had a dementia moment. I'm old now.
Yeah.
One thing we didn't talk about was the... you actually referenced it earlier, but the D&O policies. Also super important for M&A transactions. Can you just run quickly through like a D&O policies and then also like a D&O tail and what that includes, all that kind of stuff?
Yeah, I mean, directors and officers liability policy covers all the official directors and officers of a company, and especially with private equity transactions, usually, they take a seat on the board, when the new company is formed after closing, and so they want to make sure that they're protected, right, for certain decisions that are made, and it'll cover you against employment employment lawsuits against you, valuation of the deal, shareholders could sue you. There's a lot of different ways they can come after you. So it protects them moving forward. But I think what you're probably getting at more than anything is the long tail liability. Normally what happens is a seller may have those policies already in place. And so the seller, you want to make sure that they buy a long-term D&O policy, which means the seller, they have a policy in place. If all of a sudden, the management team that crosses over to the buyer after they buy the company, they get sued for something that they did pre-closing, they don't have to file a claim against the new D&O policy moving forward. They can go back and have that covered up to a certain amount of time. Usually it's 3 to 5 years, where that pre-closing act that they were being sued for is actually covered under that policy. So they have coverage, and it's good too because a CFO, a CEO, they don't have to worry about that stuff. At the end of the day, they know, hey, I've got a policy. Don't worry about it. We don't want that on your mind. If you're the investor or private equity fund that bought that company, you want to make sure that your management team is focused on running the operations and being a very profitable company. Right? You don't have to worry about some lawsuit and all of a sudden you're not covered for it. This way they know that, hey, look, if something comes in, I've got a policy. I'm covered for certain acts I did before our company was bought.
And pretty reasonably priced policies, right?
Oh, yes.
It's nowhere near a reps and warranties. These are pretty cheap policies.
Yeah, they're pretty cheap policies, especially for private companies. Yeah, private companies, you're talking about prices anywhere from $20,000 to $35,000.
Yeah.
If certain private equity funds, what they'll do is they'll buy what they call a portfolio program, right? Just for executive risk type policies, which is your D&O, your employment practice liability, fiduciary liability, crime. You might even throw some cyber in there as well. And they'll have a portfolio program where, if that's in place, that carrier that's already doing that for all their portfolio companies, they'll literally do it for $12,000 or less. I mean, I've seen some do it for $10,000 because it's we're doing a ton of business with you. It's like bulk purchasing.
Sure.
Right?
Yeah, right.
Pick a carrier like Chubb, or AIG. They'll just say, "Oh yeah, we'll take care of that." And it's super cheap.
Yeah.
So it's one of the advantages I think that private equity funds and family offices will get, because
They're volume players.
they're volume players, and they'll do a portfolio program and pick a carrier, and then they do all their D&O and other policies for them.
Yeah, just another one that's good to provide protections for the parties.
Yep, for sure.
Before we recap, I want to put you on the spot. I didn't give you any prep time for this, but do you have an interesting insurance request that either you completed or referred out to somebody else? What's kind of a unique, Lloyd's of London was flashing in my head as we're talking, and I'm just wondering, do you have any kind of maybe out of the box type insurance request, whether it's a part of a deal or it was the whole request that came up and that comes to mind for you?
Yeah. I guess I'll do one that's kind of relevant to what we're talking about. I was doing a deal recently, and the buyer had asked us if we could cover AI in the reps and warranties. And I'd never heard of that before. It was a technology company, and they wanted to make sure that AI was covered. And I'm like, wow, I've never even been asked that before.
Interesting.
Didn't even think about it. And the story hasn't ended yet. We're still going down that road, and we're like, is AI automatically covered under this policy? Are we, it's not excluded, but they asked the question: is all the AI covered that we're doing? And I'm like, wow, so
what are you concerned about?
Yeah, so it's a little out of box, and I'm kind of like,
interesting.
Yeah, right.
It's silent on it right now.
Sure.
And I'm like, well, I don't know. I guess I got to look into that and see if these carriers have any issues with that. But we haven't heard of any exclusions to this point for AI on the reps and warranty policy. But
that's super interesting.
That was something that was interesting just recently, and it's got everybody kind of up in arms in our organization. Everyone's looking into it and diving into it, and even on the carrier side.
Yeah.
So
I'm super interested to know what they're doing with the AI that they feel like they need to be covered in the first place.
Yeah. I wish I could tell you, but I have to kill you.
Right.
That's
I'm
interesting.
Under an NDA. I can't exactly tell you.
I'll plug my ears. Tell everybody else.
Yeah, but that's one that's kind of relevant to what we're talking about that just came up. And,
interesting.
And everyone's like, geez, I wonder if they'll start excluding AI.
Yeah, right.
Because, it's
have its own policy.
Bit of an unknown. Yeah.
Right.
Yeah. I mean, look at cyber today.
Right, exactly.
Talk about a coverage that's taken off.
Yeah, we didn't even get into the cyber coverage.
20 years ago when it was first coming out, hardly anyone even knew what it was, or rarely anyone bought it.
Yeah. Look, it's super interesting, but very short story. I went to an insurance company to visit them. They were having kind of like an open house with a networking group I was a part of. And the big part of what they do is in the cyberspace. And they have a TV up on the wall when you walk into their office. And it's literally, here's all the current cyber attacks that are going on. And it just shows like it'll scare the hell out of you when you see all the attacks that are going at Washington, D.C. You're like, oh no. Like what is
like
but it's, by the way, it's not one way. It goes right back over there. So like it was super interesting to see that. Like it was bizarre.
Yeah.
You don't realize in real time how much activity is going on. That's like Korea just stole what, like 20 billion or something like that in Bitcoin or something like that.
Yeah.
The largest ever heist from.
Yeah.
It's crazy.
Too many people have too much money.
Right.
You know what I mean?
Right.
It's just wild.
Think if that knowledge and ability was put to good use.
Correct.
Yeah.
For sure.
Yeah.
Well, I'll summarize a little bit key takeaways. If I miss anything, let me know. But just from a big picture, when we talk about kind of insurance in the environmental space, banking space, in the deal flow space, it really provides a protection from financial losses and the unknowns that could come up. It also is a negotiation tool, right? It can bridge the gap between a buyer and a seller as to where they're at in the transaction and what they're comfortable with. Mm-hmm. And then we always talk about those comfortability down the road. So if somebody walks away from a deal, they are fully covered, and vice versa, a seller is covered to some extent. I mean, it seems like an invaluable tool that maybe should be used more, and as you guys mentioned, should be a part of every deal. Is that kind of a few high-level key takeaways? Do you have anything you'd like to add to that?
Yeah, no, those are all good points. And if I was to add something to that, I would mention that, normally the cost of these policies, once they're determined, then there's a little bit more of a negotiation on the actual enterprise value of the purchase agreement. That cost will be taken into account, especially on the larger deals, because it can be pretty costly on deals that are have an enterprise value of $500 million and up.
Right.
And you can go all the way up over $1 billion. There's enough carriers in the marketplace where you could do a transaction that has a value over $1 billion.
Yeah. Especially when you're talking about those percentage points that you were talking
Sure.
about.
Yeah, right.
Yes.
It's appetizing.
Yeah.
Mm-hmm. And, then, once they know what the price is, they settle on price, then sometimes they adjust the price of, the deal itself.
Sure.
So I would just say that it can have an impact on the overall price, down the road once they finalize it and know exactly what it is.
Yeah.
Yeah.
Well, look, you brought really, really fantastic information here. I would suggest anybody who wants more information, reach out to Kevin directly.
Absolutely.
He's been a great resource for me personally. You have educated many people that I know about insurances and where they apply. And look, your knowledge kind of across the board. I mean, we only touched on the transaction stuff today, but you are a wealth of knowledge when it comes to the insurance industry. So we really appreciate you putting the time in with us today.
Joe, it's not because I'm smart. It's just because I've been around a long time.
The long game. The long game.
The long game. The aggregation of experience.
Wisdom is earned, Kevin.
Yes.
Wisdom is earned.
Right.
But in closing, we like to do something fun with all our guests on the podcast. Each episode, we like to have our guests or one of us will drop a location related to a transaction where you're having some kind of interaction, right? Mm-hmm. So could be coffee with or breakfast with somebody that maybe is bringing a transaction over to you. It could be a lunch with a prospect. It could be a closing dinner or drinks with somebody to celebrate. Mm-hmm. So do you have a good location that you like to go to for these kind of interactions?
Well, I sort of do. Usually when we get a deal done and it's successful and I'm working with an investment banker or a private equity person or even a client that's a corporate strategic buyer of something and, it's been a grind and we get it done, the deal's done, everyone's happy, everyone walks away happy. I prefer to go to a place that's on both sides of town, Churchill's.
All right. Okay. Love that.
I enjoy a good cigar. I can't smoke as many as I used to. I had quadruple bypass surgery 5 months ago, but
nobody could tell. I can tell you that much.
Yeah, I'm recovered fully. I'm recovered fully from it.
Incredible.
But, the food's pretty good there. It's underrated in my mind, and it's a good environment, and it's kind of my go-to where I like to go.
Shout out to our friend Dylan Straka over at
Wild Bills.
Yep, Wild Bills, owners of Churchill's. So always a valuable asset in our tool belt. But,
interesting to hear on the closing side because I feel like there's business being done either on the front end, right? Negotiations are opening up. People are celebrating after a deal's done. I mean, there's all kinds of business activity kind of in any cigar bar, but especially those ones.
Yeah, the ones where it's a happy conclusion and it's a celebration.
Yeah.
It's a great place to do it.
It's a great place to do it. Yeah,
it really is.
Yeah, everyone's pretty happy there.
Yeah.
So.
Agreed.
Awesome.
You never see a frowning face in the cigar bar.
Right.
Now that I think about it, as of you saying that, I've never seen somebody just grumbling in the corner in a cigar bar.
No.
Positive energy.
Most people seem positive and relieved.
Yeah, right.
Almost casual relief, sitting back in their
catching
chair,
a breath.
right?
Yeah.
So
that's a good one. We haven't had that one yet. So thanks for bringing that one to us.
Yeah, I love it.
Thanks for asking the question.
Yeah, and thanks for joining us overall. We appreciate it. Keep an eye out for this podcast and share it with your friends. Like Joe mentioned, if you have any questions, reach out to us, but also reach out to Kevin and his team. You mentioned it. You guys have a wide reach, and you can cover a lot of different things. So thank you for being with us. Thank you for sharing the wealth of knowledge.
Well, thanks for having me.
Yeah.
It's a privilege. It's an honor. I consider you guys both friends and, great business partners, and let's keep it moving.
Yeah, absolutely.
We'll have to have you on again for something that's dialed in on specifically one topic, and we'll get real granular on it.
Mm-hmm.
Okay.
I think that would be very
me.
beneficial.
Yep.
Well, thank you for joining Making the Deal, Frameworks for Transactions. I'm Shawn Mercino.
I'm Joe Allen.
Thanks for joining us.